But the first myth that we want to address is probably the most common one that we all deal with. And we all have this inclination to want to time the market. So a lot of the questions we get sometimes go like this. Clearly the stock market is going down and clearly it's going to get worse. Why not just go to cash now, wait this thing out, after the recession clears, we'll get back in the market. Apollo, that's something we have to think about and talk about a lot. How do you address that myth, specifically?
Yeah, and it's in a way understandable because I have to say, everybody, myself including you, everybody works hard to set some money aside. And you save this money and you invest it because you want it to grow. And it's really hard to think that I could lose some of that money. So people thinking that somehow is a good idea to avoid the market downturns and not take those losses. I think, again, it's understandable. And in fact, Robert and Charlie, I actually had the exact same thought when I started my PhD program, and I started looking at numbers and having data sets and having really good professors. And my idea was that there are times when it's so obvious that the markets are not really going in the right direction and you ought to get out. You want to just move out of the way and then come back at a later time. So the idea that it's intuitively appealing. So in that respect, I totally get it that's how many people define successful investing. And what I found, being in industry for all these years, is that, in fact, even as it is intuitively appealing, the execution of that strategy is when you run into trouble. So it's not that the idea is not good. It's just that how do you execute it? And I'll give you some of the issues that I faced myself, and I've seen over the years many other people dealing with. The first problem that I found is that invariably I could tell myself, maybe the market's too high, or I look at valuations and they're too high. So I make the decision that I want to sell. The trouble is that when you make the decision to sell, you also have to think, am I going to be out of the market forever and ever and ever? And most often the answer is no. Of course, at some point I want to come back, as you said. So then what you have to think is that not only do I have to know when to get out, but there's an equally important decision that I have to make at exactly the same time. When do I get back in the market? And that's the issue, is not making one correct decisions, but making two correct decisions at the same time. Because if you don't make the second decision on when to get back in, what I found with my own personal experience is that the stress of being in the market is very quickly replaced by the stress of being out of the market. Because at that point you see the market going up and you can wonder, well, when do I get back in? Particularly if you already took a loss, it's like, I'm not even recovering my losses and the market's going up. What do I do? And I've met so many people who, during the pandemic, during 0809, during, all these times when the market drops, they might sell and perhaps they might avoid some of the downturn, not all of it, but some of it. The trouble is that invariably the question that I get is like, when do I get back? And by then the market's actually higher than when they sold. And by then, obviously, they have a loss, a net loss. So to me, the first thing to consider is not only that you need to know when to get out, but it's an equally important decision to know when to get back in the market. The second thing that is important to know is the reason for suggesting not to get in and out of the market is really has to do with trying to understand the nature of the stock markets. And everybody's been trying to predict the stock markets for a very, very long time. And the reality is that it's really not possible. We know that the nature of the market is to fluctuate in value. That's just, we know that's the case, because if you look historically, the market's never been steadily going up. The stock market's always been, kind of fluctuating. So, there are times when it goes up and times when it goes down. And we call these times bull markets and bear markets. And the popular definition is that when the market goes up by, but goes down by more than 20%, we call that a bear market. Otherwise, it's a bull market. So what do we see there when you actually look at the data going back to the 1920s, since we have good data in the S&P 500, which is a good metric of the U.S. market? What we see is that the nature of the market over this entire period is to have times when it drops. And what you see back in the 1930s, there were significant times when the market dropped. There are quite a few periods when the market dropped in this bear territory. But what you see is also the bear markets, which are the ones in yellow, they don't tend to last terribly long. The shortest bear market that we had was in 2020 during the pandemic, and that lasted a single month. We had a bear market for a single month. We had a bear market this year for a short time, and then it turned into a bull market. And then, you see here it's 2 months or 13 months. So it's not exceedingly long, especially when you compare to the length of a bull market. The bull markets tend to last a lot longer than bear markets. The idea here being that we know that the nature of the market is to fluctuate in value. We know that's the case. Trouble is that it's not in a predictable fashion. So the second reason I'd say, it's not necessarily a good idea to get in and out of the market beyond the fact that you have to make two correct decisions. The second one is that we know the nature of the market is to fluctuate. We know at some point there'll be a downturn, the same way that we know that here in Los Angeles, one day there'll be an earthquake. The knowledge of the earthquake or the market going down is not really useful unless you know when. And if you look historically, there's not a pattern that tells you that what's going to happen. From month to month, the market is pretty random. So that's the second reason that I would say. The third reason is that we want to look at data and evidence. And whenever we look at data, I wanted to know, in my own experience, why is it that I would consistently fall behind a stay invested strategy if I moved in and out? Because again, I was earning a PhD. I thought I was pretty smart, which I'm average. I'm not any better or any dumber, but I wanted to understand, why is it that I would consistently just fall behind? And what I found is that the nature of the market is quite interesting. Maybe I'll ask you folks, because I've been talking for a while. If you look at the S&P 500 on a daily basis, what split do you think is in between good days when the market goes up versus bad days when it goes down? What's the positive, negative, the good days, bad days in the market, roughly speaking, over the past 2 years, 5 years, 10 years, what is over the long run?
I'll take a guess, Rob, and I guess the good days are 52% and the bad days are 48%.
Yeah. I'm going to go 51-49.
Wow, you guys are almost spot on. You just missed it by one the other way. It's actually 53% roughly of all trading days are positive and about 47 negative. But, depending on the time period, it could be 52, it could be. But the idea is that on a daily basis, it's pretty much a flip of a coin. You can't really tell, is the market going to go up or down? It's just not really possible to tell. And just the nature, that's just, you can't really tell. Now, the thing is that if you now switch the time horizon, because most people don't get in and out of the market daily, hopefully, because that costs a lot of money, but you do it monthly. And now you're asked the same question. If you look historically in the S&P 500 on a monthly basis, what's the split between positive months and negative months?
I think it's a little higher, 66, maybe 2/3 versus 1/3 possibly.
I'm going 67 this time.
Actually, you're a little bit the other way now. It's roughly about 63. So not far from where you're. It's pretty much spot on. But what you're doing is you're improving your odds. If you simply don't look at the market daily, but you actually look at it monthly, instead of 53 is roughly about 63% of the time the market goes up any given month. And here's a way to think about this. If you get out of the market, then it's possible that you miss a bad month and you pat yourself on the back and say, great, I saved myself some money. The reality, though, is that if you end up being out of the market, it's possible that you miss a bad month, but what is it more likely for you to miss, a good month or a bad month?
Right.
And you have a better chance of missing a good month. And again, what happens in the market from one month to another, it's completely random. So getting out of the market would be like going and playing a game where 63% of the time you stand to lose. Why would anybody do that? So to me, ultimately, it's another reason that staying invested is better. And the last reason that I'll give you, again, from my own personal experience, when I sold, thinking that I can't take this, a lot of it was emotional. But when I sold, one surprise that I got was from my accountant, because he called me up and he said, well, when you sold, you had appreciated positions. So now you have to pay taxes on some of the gains. So when I got to reinvest, I didn't get to reinvest the full amount. I got to reinvest the amount that I sold minus the taxes that I voluntarily chose to pay to the government. So be careful, because when you sell and you have appreciated positions, you're not going to be able to reinvest the same amount of money. It's going to be less. And because of all these reasons, that intuition that seems so appealing, let's get out of the market, come back in, I wish it was possible to do it. In my experience, nobody has been able to consistently make these two correct decisions. Nobody's been able to actually defeat the odds, and nobody's been able to predict the fluctuations, the ups and downs in the market, and for good reasons. Listen, folks, the reason that the market's going down quite often is because of unforeseen events, things that you could not see. If you were in November of 2019 and everything looked pretty good, how many people would have guessed that a month later, randomly, a virus will emerge and create a pandemic in the world? It's if you're trying to say I can predict that specifically, it's just silly. You don't need that. That's the good news. You don't need any of that to be a successsul investor.
And even if you would have predicted that, then like you said earlier, then you got to find the right time to get back in, which
Exactly right.
so even if you knew what was happening, you'd probably be wrong.
Yeah. And there's a great study that looked at the cash flows and how much investors sold as the market tanked. And then as the market recovered, they were still in cash. They never got back in the market. And for those people, those losses might have become permanent instead of a paper temporary loss if you just stayed invested.
Yeah, absolutely. And, one of the things I remember, Apollo, from, again, when you were giving your speeches almost weekly in March of 2020, the thing that stuck out to me the most powerful at that moment was when you leave the market or go to cash, you're simply replacing one stress with another.
Yep.
Because that's really what it was forget about all the math and statistics. It was just very stressful for people, very scary, but you really just replaced one for the other. Because Rob, in fact, you and I did a video right when you were brand new at Leading Edge during that time. And we said, we showed the graph of all of 2020 and said, when was a good time to get back in? It was, the news headlines anyway, for that whole year were scary, not to mention a little election in November of 2020, right?
Yeah, absolutely. And by the way, I mean, I'm going to bring up one other thing that it was so stressful, and quite often, whenever I had a chance to interact with individuals and their advisors, one of my first questions was, people say, I'm in retirement and I'm scared of what's going on. And my thought was like, okay, so, you have a financial plan. The advisor actually helped you with a financial plan that's customized to your needs, so the question is, how much of your portfolio is invested in the stock market to begin with and what you see on the news? And a lot of the investors like, I'm not sure. I think all my money's invested. Well, and then the advisor will, no, wait, actually about half of your money is invested in bonds, and bonds have actually been going up. So it is interesting because that not every penny is invested in the market. So when you say, I want to get out, the question is, do you want to just get out of the S&P 500? Do you want to get out of the bonds? So it's much more complicated than just a simplistic view that, I'm invested in the market. The U.S. stock market might be a portion of your allocation, but there's certainly a lot of other pieces that might not move in lockstep with the U.S. stock market.
Yeah, absolutely. Rob,
fantastic.
And I'll hand it off to you for the next one, but in the show notes, we'll have an article from JP Morgan Wealth Management, and we'll have some from DFA in there as well, but it's a great article. It's the case for always staying invested, and it talks about what it looks like when you remove money and you miss those best days or months that Apollo, you were talking about, the devastating effects on your overall return. But it's just fascinating to see those numbers over and over again.